What is your investing strategy for the next year? Since the Federal Reserve has been raising interest rates for a while now, money market funds are returning very good yields for the amount of risk the fund is. Have any of you taken some of your money from stocks and ETFs and put it into money market funds? I'm curious to know how the past year's interest hikes have changed how you invest, if at all. Especially because analysts are expecting the market to dip a bit. I put my emergency fund into Vanguard Money Market, but I'm not changing my stock strategy at all. Stay the course. Same as it was the past years. Keep on buying along the ride. Long Powerball and Mega Millions. Doubling down at the right times. Keep buying index fund VT. Collect dividends. Live off dividends. Don't sell. Always DCAing VTI and building up my emergency funds. I want to build my emergency fund up a bit more. Say 6 months or so of expenses. But when that fund is up, going balls into VTI. Haha VT and chill. 100 SP growth DCA with biweekly deposits. I'm already 100 VTI. But next year all new money is going into growth. Max out my 401k in SP 500. I've got some SCHG in my Roth. But I'm not adding any at the moment. What I have is up around 45 and I sell covered calls against it. Most of the rest of my Roth is used for trading positions in MREIT common and preferred stocks. These are purely trading positions based on my evaluation of the book value of the MREITs. I used to trade BDCs too. But the discount to NAV just isn't worth it. My taxable account is a combination of Google, Microsoft, and some ETFs. I've been buying XLRE and SCHD as well as some specific rights while they are on sale. Keep maxing all my retirement accounts with VT or similar. Putting it all into mortgage. Regular amounts into VT and VU plus some dry powder for flash sales on stocks I want to own. Accumulating bonds too, unless more hikes come back on the table. VU. DCA VTI. Too easy. M and HYSA are at 15-year highs and look attractive. I know because I had a liquidity event and I'm trying to wade these treacherous waters. Okay to park cash there for the time being. But remember that interest is taxed at ordinary rates. At the highest bracket, 5.5 is really 3.3 or less. Hardly above inflation. Stocks will perform better over the long term. I have a long-term time horizon and am cautious at the same time on entry. My plan is to DCA over the next 18-24 months. Equal monthly. With acceleration points if the market drops. But I'm committed to getting in. Short or buy puts on reverse splits. Sell credit spreads on reversals. Edit I didn't realize that I was in R investing when I replied to op. How do money markets work? I have Fidelity. So do I just leave it in there as a balance? Without investing? For after tax continue to buy short-term T-bills. Once I feel the rates have peaked. Go longer on T-bills. Keep a percentage of money in HYSA for buying opportunities. For my 401k continue to max out in the SP 500. Small cap. And developed international fund in a 6:5:1:0:2:5 ratio. Unfortunately I can't capture emerging markets because my plan doesn't have it. Same as always balls deep in VU. DCA into SP index. I've learned over time it's just best to keep putting money towards the best investment opportunities. Trying to time the market and interest rates is not a game I'm good at. Yes, totally changed. I had zero in fixed income prior to mid-2022. Since then I started rolling my emergency cash into 13-week T-bills, 113 rolling every week. Since the recent bond sell-off, I've started buying longer duration bonds, 20s mostly, some 7 and 10. I've also got my operating cash in a money market. I don't really care what anyone thinks is going to happen. My allocation is based on my present and future needs and whatever the real rates are. Safety, safety, safety. VTWAX and relax. I am considering reallocating some of my funds out of VTI to RSP for a more diversified portfolio. I think the run-up in tech stocks won't last if the Fed keeps interest rates high for a longer period. Separately, I have allocated 30 of my portfolio to Treasury bills or bonds under 2 years through Treasury Direct website. I used to do money market funds, but they provide similar yields to treasuries without the state tax exemption. Art. As much as possible. It's a shockingly stable market. Broadly learning that diversification is good, and I'm more risk averse than I thought I was. It's a common fallacy. X200B. Increase international exposure from 0 to 10. Hedging against weakening dollar. Overweight cash and 1 to 5 year bonds 15-20. Will bring it down to 5 once yields go back down and or term premiums go down. Slowly buying gold. Will become 2-3 of my net worth in the next 3-4 years. No change in Roth 401k and Roth IRA 100 US stocks with large cap growth tilt. I temporarily moved my largest position from stocks to long-term bonds, multi-decade low with attractive yields. I'm playing a silly game of market timing. But typically recessions happen 12-24 months after a yield curve inversion, and we are currently at the 12th month. I've noticed some troubling signs and I could be massively off. But I think we'll hit a recession depression in 1 year. And when if Feds cut rates, those long-term bonds will pop right about the same time that the market will tank, and then I'll do the OL switcheroo and remain fully sat into VU per usual. If I need the money, I can always use a small margin loan. Algorand. I'm just DCAing into JEPQ still. Real estate, and SP 500. Tried and proven vehicles to build wealth. To stop being regarded. Cash is king. My taxable accounts, I've harvested some losses, gains, and reduced equities exposure. Transferred any equity sale to Treasury bills. My retirement accounts I've left alone and continue to invest with my regular income 401k contributions. Similar to this year. Expect more modest interest hike. Now 25 into bonds. Expect single-digit growth. Stacking SATs. DCA into VU and chill cool. I am slowing down my extra investments. I will stay the course with my scheduled investments, which account for about half of my investments on a monthly basis. The other half that I typically invest separate will go into my HYSA. Anytime the market drops by a few percent, I take it as a buying opportunity and use that extra cash to take advantage. Even timing investments by a few percent here and there can add up over time, in my opinion. It's like dollar cost averaging. Except I put a little more in on days or weeks where the market is down. I have 10 stocks I really believe in, and added TLT because it's an incredible bargain right now. I'm just going to add to SPY and sell covered calls. 65 QQQM20 Tesla 15 in phase currently, 70 SGOV but waiting to reallocate to the above. I'm trying to figure out what my investment strategy is for tomorrow. I have no idea what will occur next year. Every response in this thread is a bot. It's actually uncanny.